Welcome to part 2 of the latest podcast from Global Perspectives with Alex Stanczyk, presented by Physical Gold Fund.
Inflation.
Right. So if I'm hearing you correctly, what you're saying is basically three phases of how the inflation works. You've got the monetary inflation first, then you've got the asset inflation, which we're obviously seeing now, and then finally the velocity of money picks up substantially, and then you've got the price inflation that kicks in. So this is something that we've been discussing quite a bit in some of our other calls and interviews and discussions, and the amount of sort of water that's built up behind the dam that's available to create price inflation once velocity kicks in is really quite amazing. And I don't know that there's ever been an example throughout all of history that is anything like it. So it should be interesting for gold and for other types of things like that will either retain or grow in value in this kind of an inflation. Do you have any other thoughts or anything else that you want to talk about in regards to inflation that you think is important?
Well, yeah, inflation is always a long process, and I think central banks, they're very open about it. They always said that they want to create inflation. They said that inflation numbers are way too low, and now they say, temporarily we can accept some sort of overshooting of inflation. So we will perhaps we will accept 3 or 4% inflation rates, and then everything is gonna be fine. It's just this hubris that you cannot control inflation like a thermostat. It just doesn't work like that. It's a very, very complex project. And the thing, I think that the zeitgeist at the moment is that when you read all those very influential papers and like the Geneva report, for example, where really the most influential people come together and discuss markets, it's pretty obvious that their conviction is that central bankers basically did their job, and now it's time for the politician. Now it's time for fiscal stimulus. And we did some studies on that, and it clearly shows that fiscal stimulus it leads much more directly into the economy, which causes inflation to pick up much faster than when it comes to monetary inflation, or let's say like central bank governed inflation, because this usually goes to the asset inflation first, and then only spills over into the rest of the market. So I think with Trump coming up, but also in the European Union, they're discussing big infrastructure projects. I think that inflation will come back big time. In fact, this is a call that we made a couple of years ago, and people were laughing at us. We said that stagflation, like in the 70s, low growth but high inflation, this will become a major concern. And if you have a look at the 70s, the nominal performance of stocks was okay, but the real performance, so the inflation adjusted performance, was a disaster. Bonds were doing not really well in the 70s. So what performed pretty well? It was gold, mining stocks, and commodities in general. And I'm seeing that the stock market is priced very, very I would say ambitious. Bond market is in a 35-year bull market at the very end, and very, very expensive. So what's really cheap? I would say commodities and gold. And I think that we're really at the beginning of the so-called public participation phase when it comes to gold. Last year we have seen the lows. We have seen this accumulation phase when really, really smart contrarian macro investors started piling into gold and mining stocks, and now we are at the beginning of this public participation phase, and this party is going to be much fun.
Yes, I agree. In fact, that's something that I've been, amongst my colleagues, we've talked about this for a long time, in that even up through 2011, the majority of investors, even in the high, we were talking a little while ago about it was fun times and it was exciting. The gold price was high. But even at that high, the number of people overall, in terms of the size of the market or the number of investors that there are, most people were not invested in gold. Some very small percentage was invested. And I think you're right. I think the next time that people become substantially invested in gold, and I'm talking, when your average person's buying gold, this is going to be a very interesting and different kind of change. I think of the markets where you listen to some financial professionals and they say that there's no reason gold should have risen to the levels that they did, that it was overpriced and that it was just ridiculous. But the truth is that a very small portion of capital compared to global capital was invested in gold and is invested in gold today. So if you look at global markets, you look at all of the bonds, you look at all of the various different markets available, you're talking some 500 trillion roughly in size, where gold is only 7 trillion of that. It's a very tiny sliver. So I agree with you. I think that
it is.
I think that when we see the average person investing in gold, this is going to be a very interesting time.
We made a in our last gold report, because we're meeting, we're speaking at so many conferences. We're meeting hundreds of professional market participants, asset managers, fund managers, private bankers. We talk to, I don't know, cab drivers or nowadays you should say Uber drivers, probably.
Exactly, Uber drivers.
and we said there's basically three different kind of people when it comes to gold and the economy in general. There's the believers in the system. They think that everything is okay. They think that politicians and central bankers did a great job, and for them everything is gonna be fine. For them, their gold allocation is basically it's zero. They don't care about gold.
Right.
For them it's a pet rock. Right. They don't need it because everything is gonna be fine. Right. Then there's the skeptics. This is the second camp. Yeah. Those are people who harbor doubts about the sustainability of the extreme economic policy measures that have been taken. They're not sure, and for them, I think they're more of the momentum players. I think those are, for example, in financial markets, the people buying gold ETFs. It's very, very much pro-cyclical. So every time prices fall, they sell their ETFs, and when prices have risen, they buy their ETFs. And I think they are kind of questioning the whole sustainability of the current economic policy measures. And I think this camp is really, really big. They will become really, really interesting, because those are the marginal buyers, and they really could make a change. And then the third camp, of course, those are the critics. And I think both of us, we are in this camp, because we know that our whole monetary architecture is systemically flawed. We all know that a problem or a crisis that was caused by cheap money and too much debt, trying to solve that with more of more cheap money and more debt, that's not going to work. And the interesting aspect of that is it's a one-way street. I think we, the critics, will never go back and say, Alex, what Mrs. Yellen is doing, I think it makes sense. That's great what she's doing. Kuroda is doing a great job now. The 13th round of quantitative easing, that will change everything. It's a one-way street. We won't go back, and we will always say gold is money, and it's the best money that mankind ever had. So our camp will naturally become bigger and bigger.
Okay, so let's talk about the bond markets for just a moment. We have some 5,000 years of data confirming that interest rates have never been as low as they have been in recent times. So we have close to $10 trillion of government bonds with negative yields to maturity. What are your thoughts on this? And if this is a bubble, what happens when it bursts?
Well, we have seen in November when we have seen pretty aggressive moves in the bond markets, and there was I think 1.3 trillion of course of paper money wiped out. And that's a huge number, and this is of course it's deflationary. But if you're having a longer term chart, nothing really happened, and I cannot rule out that it will that we have already seen the lows in yields. For example, in the US, I think that if you compare it to yields in the Eurozone, I think it's pretty attractive actually in the US on a relative basis. But we all know that, of course, financial repression is a main cause for this final rush into bonds. We know that talking to institutional players, they have to buy bonds, because exactly. They are riskless, as we all know, and for them it's not easy or sometimes even impossible or forbidden to buy physical gold. It's a legal thing, and it's a legal framework, and this is one very important aspect of financial repression.
Yes, totally agree. Moving on to a different topic now. One of the hot concepts right now is this idea of anti-fragility. So what are your views on this, and how do you see gold fitting into this framework?
Yeah, we wrote I think a really interesting chapter about that in our last gold report. Nassim Taleb, who I admire quite a lot, he wrote this brilliant book, Anti-fragile, Things That Gain from Disorder. And he says basically some things benefit from shocks. They thrive and grow when exposed to volatility, randomness, disorder, and stresses, and love, adventure, risk, and uncertainty. Let us call it anti-fragile. And he thinks that stress actually is something really positive. He says that we're learning quite a lot, and we're profiting from times of stress. For example, in sports, if you always just run like 3 miles in the same pace, you probably won't get much better. So you really need this high intensity that makes you stronger. And he develops this picture of anti-fragility, and it's really not easy to explain that, as it's such a brilliant book. But what we tried to explain is if in a portfolio context, gold makes your portfolio anti-fragile. And we came up with some very interesting thoughts. And first of all, we said that if you're having a look at gold in a portfolio context, actually the years when the S&P 500 was losing most were years when gold did tremendously well. So there's a high negative correlation between gold and stocks, especially when stocks crash. Then we're talking of course about the natural let's say entropy of gold. Gold is intrinsically stable and durable because of its physical durability. It's got a very stable total stock. This is something that most people forget, the so-called stock to flow ratio. The amount of gold, so the natural inflation, let's put it that way, of gold is 1.5%. This is how the roughly 180,000 tons of gold, how this amount of gold grows every year, 1.5%. So this is roughly population growth at the moment, which is pretty interesting, I think. So that's much lower, this 1.5%, and much more stable compared to monetary inflation, which is running at on average 7% every year. So there's 7% more money in the economy. That's what I would call a loss of purchasing power.
No doubt
then,
about
of
it.
course, gold is extremely liquid, even in stress situations, especially in stress situations. So it's one of the most liquid investment assets, one of the most liquid currencies on Earth, and that makes gold very, very robust. It also has some sort of a reciprocal relationship with the monetary system. So basically gold, as you know, it doesn't have any counterparty risk. It's pure possession. And this also means that that it's a natural hedge against financial crises. And of course, there's quite a lot of other aspects. So we came up with the conclusion that gold makes your portfolio more anti-fragile. And there are several ways how you can play it. We always say you have to differentiate between performance gold and safety or insurance gold.
Yes.
If you really want to speculate on rising gold prices, that's fair enough. You can buy ETFs, you can buy futures, options, you can buy mining stocks. But if you wanna really buy insurance against hyperinflation, against monetary reforms, wars, whatever, then you should buy any ETFs or certificates. But then you really should care about counterparty risk, and then you should own physical gold. You should store it in a very, very safe jurisdiction. You should store it outside of the banking system and so on. So this is really important to differentiate. What's the purpose why you're buying gold?
Yes, absolutely agree. Okay, so wrapping things up, do you want to talk about any scenarios that you see moving forward? Are there any sort of likely scenarios you see playing out, and on the flip side of that, other scenarios that maybe are less likely, and how do you see these things happening over, let's say, the next 2, 3, 4, 5 years?
Well, I should be cautious because I said before that the Austrian school doesn't make any forecasts, or is very let's say strict when it comes to making big calls. But of course, as an analyst and as a fund manager, I have to do, but I also have to prepare for different scenarios, and that's basically what we're doing. I think that our main case is basically from reflation to stagflation. We really studied the stagflation of the 1970s quite a lot, and we came up with quite a number of similarities. So stagflation is really something that we believe that is quite possibly gonna happen. Then of course there's the Goldilocks scenario where everything is gonna be fine. I think we should not be too pessimistic. There's a beautiful book by Julian Simon. It's called The Ultimate Resource, and the ultimate resource is basically in between our two ears. It's our brain, and we should not forget that human beings are extremely innovative, and there's quite a lot of positive things going on in technology and so on. Also in the blockchain developments, bitcoins, cryptocurrencies, and so on. There's very interesting stuff going on. I think that, of course, the election of Donald Trump might be some sort of a real game changer in politics. I often say that I'm not sure he's probably going to be the worst or the best president for decades. Yeah, you just don't
it's
know.
yet to be known, right? It could go either way.
But I think if in the first couple of days, I think he also did really some good things, and he actually delivered the things that he promised in the campaign, which is not so common with politicians. So I think that in the gold scene, people are often too negative and try, to they should avoid the confirmation bias, only seeing negative things.
Yep, I agree.
But still, there's basic math, and we just have this huge pile of debt, and it has to be liquidated sooner or later. It can be liquidated by inflation, which is what politicians and central bankers prefer. It can happen through a debt restructuring. It can happen to defaults due to deflation. There's only a few ways out, but it will happen sooner or later. But either if we make the stagflation call, or the inflation call, or also the deflation call, or the Goldilocks scenario, I think that gold just has to be part of your portfolio. As I've said before, I really mostly read about history, about monetary history, about politics. I don't care about daily noise that is happening every day. I try to understand the big picture. And I think at the moment, when we're in big currency wars, because Donald Trump basically said, and this is something that U.S. presidents for many years never did. He talked about the dollar, and he said the dollar is too strong. So this basically means, as also Jim Ricketts would probably agree, that we're in a new round of currency wars. And we know that Mr. Draghi wants a lower euro. We know that Mr. Kuroda in Japan wants a lower Japanese yen. We know that the Chinese want a weaker yuan or renminbi. So the beauty is that gold is not participating in currency wars. So that basically means that your purchasing power. I'm not sure if gold is the right thing to become rich, but it's definitely a great choice if you want to stay rich. So I think this environment, you just have to own gold.
Yep. Is there anything else that you would like to talk about that you consider important for people to know, for our listeners to know, that we haven't covered yet today?
We could talk about soccer in Austria, but I think that's probably one of the most useless pieces of information for your listeners. We talked about quite a lot of different interesting topics. We've got quite a lot of research on our webpage. We're already working. We Trust report is going to be published on 1st of June.
Okay. Look forward to that.
And there's so many interesting things to write and to think about and to research. I think it's going to be an interesting publication again.
Yeah, very much looking forward to it, as always, every year. It's one of the publications that I don't miss, and I think really anybody in our industry and anybody who's has any interest whatsoever, it would be greatly benefited by taking a look at it. So for those of you who are interested, we will be posting links to where you can get more information about Ronald Stoeferle and the In Gold We Trust report, and it will be located in the information section of this podcast. Ronnie, I want to thank you so much for your time today. It's been a great discussion, and really appreciate it.
Thank you very much, Alex. It's been a great pleasure, and all the best to you and your listeners. Thank you very much. Take care.
Thank you, Ronald Peter Stoeferle, for sharing your insights with us today. And thank you, Alex Stanczyk. And most of all, thank you to our listeners for joining us in this second edition of Global Perspectives. Let me encourage you to follow Alex on Twitter. His handle is @AlexStanczyk. If you've enjoyed this podcast, please recommend it to your friends. If you're watching on YouTube, please click like and subscribe. And if you're listening on iTunes, please give us a rating and a review. So goodbye for now, and we look forward to joining you again soon. You have been listening to Global Perspectives with Alex Stanczyk, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Alex Stanczyk and other thought leaders in the fields of geopolitics, economics, and the global monetary system.